The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
10 years from now, we tend at Investor Resources, we tend to look on the shorter term of investing. We're not buy and hold investment advisors. We don't stick to a static long-term asset allocation model, but in looking at things, there are things in the long-term view that can help us with our investing process. When everything seems to be breaking down, the longer term picture can bring a bit of clarity and sometimes even a little sanity into view. So let's take a look at some 10-year timeframes, not the usual 50 and 90-year returns that the advisors pull up on a mountain chart to try to convince you that nothing ever goes wrong and to just keep doing what you're doing no matter how bad things get. Let's just look at the next 10 years and see if that'll tell us something about what's going on and give us some things that we should be thinking about. Right now, out there, it feels a little, we're in a weird place from the perspective of the economy and financial markets. Housing prices seem too high. Consumer prices seem too high with the inflation we've had, especially recently, even though it's moderating some. Stock prices seem too high. We're at all-time highs across the board. Everybody's getting a little twitchy about that. And government debt, of course, just seems incredibly high. And at some point, everyone feels like, we need to do something about that. So everything just seems a little bit off right now, and it's creating a great deal of anxiety in all areas of investing. And we get it. We understand why people get worried in times like this. Many of these things, the things I just mentioned, they're cyclical. And as far as investments go, though, those lines can't go up and to the right forever. They just can't keep climbing forever. Bear markets happen, financial crises happen, recessions creep in. Those are all features we can't do away with. Those are part of the economy and investment markets. Those are the things that keep us up at night. What's coming next? What is it that we're looking at here? And is it even worth being in this market or not? So it can be difficult to see past the short-term worries when we know bad things can and will happen. Stocks will fall. We've seen it. The economy will contract. We just went through that. There are very few times where there are any gains in the market where there's not some pain to go along with it. And it's often very difficult just to take that first step and get started. You can't even, you don't even want to get going because you're not sure where this thing ends. It's very tough to keep going even if you're already started and everything seems to keep getting steeper and steeper. And is it worth the work? Is it worth the trip? And sometimes we just need some clarity at a point like this to keep us focused and keep moving in the right direction. So here are some questions that we'd like to consider when we're trying to look past short-term worries. And there's always short-term worries out there, but we've got a bucket full right now. 10 years from now, do you think the stock market prices will be higher or lower? That's a great question, and nothing specific. Don't make a call on any specific stock or fund. Just in general, will market averages be higher or lower 10 years from now? Think about that for a minute, and then let's take a look at some 10-year periods and see how that's panned out over the years. In all rolling 10-year periods over the past 100 years or so, the S&P 500 has been positive 95% of the time on a total return basis. Positive 95% of the time. There can be lost decades, long periods of time where the markets go down. That's never completely out of the realm of possibilities. That's always a possibility, but it's rare for the stock market to be in the red over a decade-long period. The only times the US stock market has been down on a 10-year basis was following the Great Depression. Back here, you can see here's the zero line. We're down below zero here. And during and just after the Great Financial Crisis, over here in 07, 8, and 9, those are the only two times. All the rest of the time, we're in positive returns. Sometimes, like the late 60s and the early 70s, it's declining the entire time. So prices, the returns are getting lower and lower. That's nothing you'd like to sit through. We don't. That's why we're not buy and hold investors. We don't want to see that in our client's portfolio. But very rarely do returns go negative over a 10-year period. So just looking at those 10-year chunks, there's a really high likelihood that you're going to have positive returns, sometimes better, sometimes worse, but almost always positive. What about housing? 10 years from now, do you think housing prices will be higher or lower? Not just where you live, but the national average, the big picture, real estate in America. What do you think? Housing prices, up or down over 10 years? Well, again, 10-year rolling periods, almost 100 years of data here. US home prices have been positive 97% of the time over a 10-year period. Housing prices can fall, of course, but it's a really rare occurrence for nationwide prices to go down for a decade. Again, if we're looking at that 10-year period, just doesn't happen very often. Again, the only times national home prices have declined over a 10-year period, the Great Depression, and then a brief time following the housing bust after the Great Financial Crisis. So here in the Depression and here in the Great Financial Crisis, again, that's twice now we've seen that the only two exceptions to those growth periods of almost 100 years were the Great Depression and the Great Financial Crisis. It's important to remember, I think, that we all invested through the Great Financial Crisis. We didn't see this one. We were alive and well, and we saw that everything was falling. And as investors, we survived that. We survived some of the worst times to ever hit American financial markets. And quite frankly, we all deserve a round of applause for that. And never forget that we made it through some of the worst times we've ever seen. And when we start worrying about what's coming up next, we've already lived through some of the worst things the market has to pitch at anybody and has ever pitched in its entire existence. So we've seen really bad times, and we know we can come out on the other side of that. It's important to remember that everything's probably not coming to an end. Things will continue. We didn't go out of business in the Great Financial Crisis as a country, even though at the time it really seemed like it might happen. It didn't. And it's just one of those opportunities to remember there are a lot of bad things that can happen, but there are far fewer bad things that actually do happen. 10 years from now, do you think the overall consumer prices will be higher or lower across the board, just everything? Will it cost more, just to be alive in 10 years? What do we think about how that's going to pan out over a 10-year period? And over the last 100 years or so, again, the consumer price index has been higher after 10 years, 93% of the time. The only time we had deflation over a 10-year period was back here in the early 30s following the Great Depression. Again, the Great Financial Crisis did show up here in the 07, 08, 09 period, but it's tiny as far as the consumer price index goes. So since World War II, there hasn't been any 10-year window when prices fell. So after the Depression, that hasn't occurred again over a 10-year time frame. And so this is not great news for investors, of course. The consumer price index, inflation in general, that's one of the things that's continually chasing our investment returns. That's one of the reasons we're always looking at what's an inflation adjusted return, because this has just been relentless. This is just coming after us the entire time. And just for another kind of quick way to look at this, looking at long-term inflation, think about wages. You think wages are going to be higher or lower in 10 years? Well, the U.S. minimum wage tells a story of, again, since World War II, wages are going to be higher. Kind of a little flat here in the last 10 years, but over the long haul, we are trending up, and there's no sign that that's going to collapse anytime soon. So this is just another way to look at that inflation number, and kind of a reinforcing piece of data that kind of permanent long-term growth in inflation is with us. It's going to stay there. We like to have it under control, but it's never going to go away. 10 years from now, what do you think about the economic activity of the entire United States? Is it going to be higher or lower? Again, nothing specific, just the total GDP in America. What do you think about the outlook for the U.S. economy over a 10-year time frame? Again, looking back, if we just go to post World War II, so the last 80 years or so, there hasn't been a single 10-year window when gross domestic product in America was negative. That's a remarkable. That even surprised me a little bit. Not once since the 40s has America had negative GDP over a 10-year period. In fact, the lowest growth over any 10-year window going back to World War II was a gain of more than 30%. And that period coincided with the COVID response in 2020, where we saw the largest drop in GDP in modern economic history. This little gem right here, there's an adjustment in GDP that will get everyone's attention. But then that's 2020. So if you drop back to 2010, you can see that we still had a gain over that period, even with the largest drop in GDP in history. It's amazing bit of resilience. This graph really is the illustration of the saying, never bet against the American economy. We are very resilient, and we've proven time and time again that we're going to find a way to keep on going no matter what happens. Things change, what's successful changes, but overall, the U.S. economy continues to grow. So we're not trying to be blind to the risks here. They're there. We've studied financial market history a lot. We look back a lot to see what's occurred before, not because we necessarily think it's going to happen again, but just to see what's occurred in a large scale, big picture economics. And we know that we're always, one gigantic financial crisis away from a bad decade or so, but that rarely happens. But looking at these, we're simply thinking in terms of what's the baseline here? What happens most of the time? If there's any kind of safety net out there, where is it? And has it worked before? And those are important questions to ask, and we want to see how that's worked. Then we can focus on, do you want to take your chances on the stuff that only happens, 3, 4, 5% of the time? Or do you want to hook your wagon to the things that happen over 95% of the time? That's the growth picture. While this portion is always there, the big picture says most of the time we're going to have positive returns. Not always in the same place. That doesn't mean you can set it and forget it. That means you need to be paying attention all the time. But that means the odds are in your favor even when things are looking bad. Things are going to turn around. Historically speaking, there's no precedent for things losing it and never coming back, except in specific industries where it's time to rotate out of buggy whips. The buggy whip industry is going to be gone, and so we need to move on to something else. And that's why you need to pay attention to exactly where the economy is strong and weak. But there's a really excellent chance that we're going to have, even in bad times, we're going to have recovery. So the stock market will probably be higher in 10 years. Housing prices will probably be higher in 10 years. Consumer prices, on the negative side, those are probably going to be higher in 10 years. The economy will probably be bigger in 10 years. Those are the probabilities. We can't guarantee any of that. Hence the probably hedge. We can't guarantee that all that's going to happen. There's no such thing in financial markets as always or never. Nothing always happens and nothing never happens. There's always something new happens that's never happened before. and you always have to be ready for that. That's why we're always ready to change our investment makeup. If it looks like things aren't going to work themselves out in parts of the economy this time, we need to be ready to make those changes. You can never blindly trust the past to bail out the future. You have to be paying attention all the time because things change, and you need to be ready for that at all times. The point here is that we all need to earn more money on our money, and then we need to save that and invest that money if we want to keep up both with our future needs and stay one step ahead of that inflation bogey, which just relentlessly keeps rising. And the only way to guarantee that, and the only way to guarantee we don't fall behind is by staying invested. The only way to guarantee a loss is to not be invested in anything. None of us can afford to be scared out of these markets. None of us have any chance of meeting our investment goals long term unless we stay in something that's going to be increasing our net worth, and hopefully taking a look at slightly longer term trends is going to help us stay the course, claim our piece of America's future. It's going to be out there. Keeping longer term views of things can help us get through those short term challenges of investing. It can keep us in the game when everything else is trying to talk us into getting out. And it's very important to stay in. Like I said earlier, where we stay in makes a big difference, but you need to keep your eyes on, we need to be invested, and we need to be protecting capital. So sometimes we need to change where that is. But longer term, we're in a pretty good spot. We're in a pretty good place to be investing. And it's important to remember that when things seem to be a little out of kilter, like right now.